Okay, let's get into it. We're doing a deep dive today on Plasma. Token symbol XPL. It just launched September 25th, actually, with this, well, really ambitious goal.
Yeah, making stablecoin transactions like as easy as sending a text. Instant and basically free.
And the launch itself made huge waves.
Right, absolutely. A $2.4 billion market cap, day one.
Wow.
Yeah. And it's important, for you listening to kind of grasp how that number works. Total supply times the price, but also why the tech might actually deserve some of that hype, even with what happened to the price later.
Right. So that's our mission here, isn't it? To sort of unpack that core tension, the really impressive tech versus, well, the financial reality and the risks tied to this XPL token itself.
Exactly. Let's start with the tech, because that part is genuinely interesting.
Okay. So the big headline features 0 fees for sending USDT. 0.
And speed. They're saying under a second for transactions.
How are they even doing that? That sounds incredibly fast.
Well, they built their own system. It's called Plasma BFD. That stands for Batching and Fast Delivery. You can think of it like a super specialized highway just for these small, quick stablecoin payments. Allows for, they claim, over 1,000 transactions per second.
1,000 PPS. Okay. And they tackled that annoying crypto problem too, right? Needing the native token just to pay fees.
The paymaster system, that's key.
So you can just pay the network fee using the stablecoin you're sending, or Bitcoin.
Exactly that. It removes a major friction point for users. Plus, and this is big for adoption, it works with existing Ethereum apps. Developers don't need a massive overhaul.
No painful migration. That helps explain the launch traction then.
Definitely. I mean, they didn't just launch with promises. They had, over $2 billion in stablecoins locked up already?
Yeah, and over 100 DeFi apps connected on day one. You mentioned Arave, Athena, big names.
Right. So the utility case, that initial demand, it was clearly there. That speaks volumes.
Okay, so the tech looks solid, solves real problems, but as often happens, there's the other side of the coin. The team, the token price action.
Yeah, let's pivot there. The team sounds impressive on paper, like 50 people, backgrounds from Google, Facebook, Goldman Sachs, and backing from Peter Thiel, the PayPal co-founder. That's, serious pedigree.
It is serious pedigree. But digging into it, some sources mention a bit of a mixed track record for some team members' past projects. Could that be part of the story?
It's always part of the context, isn't it? It maybe connects to what happened with the price. It launched around $1.70, right?
So yeah, and then plummeted hard, down to like 0.074 cents within 4 days.
And now it's hovering somewhere around, 841 cents, even with pretty high daily trading volume, like $320 million.
So, okay, some profit taking is normal after a big launch, but that kind of drop feels significant. Structural, maybe?
I think so. And when you look at the tokenomics, you really start to understand why there was so much sell pressure baked in from the start.
Talk about the supply. It's 10 billion total XPL tokens.
10 billion total, yeah.
Yeah.
But only 18% were circulating initially. That's key.
And there were some red flags around how they handled that initial supply going to market, weren't there?
Big ones. Reports indicate they sent something like 600 million XPL straight to exchanges before the public launch.
Whoa.
And almost half of the tokens allocated for the ecosystem were unlocked immediately.
So basically, they set it up for a massive dump right at the beginning.
It certainly created the conditions for it.
Yeah.
Huge supply hitting the market when excitement was highest. The price chart reflects that perfectly.
Okay, so that explains the initial chaos. What about looking forward? You mentioned unlocks.
Right, the future risk. This is where it gets pretty concerning from an investment perspective. The team holds 25%. Early investors hold another 25%. That's half the total supply right there.
And those are locked.
Locked for 3 years. So the really big potential sell-offs, the major dilution events, are mostly pushed out to 2026.
3 years out. That's a long shattered over the price potential.
It is. And even things like validated rewards, they start high at 5%, then drop to 3%. It incentivizes early stakers to sell rewards rather than hold long-term, adding more sell pressure.
Okay, let's synthesize this for the listener. On one hand, you've got potentially game-changing tech. Instant, free stablecoin payments, easy integration, solves a genuine pain point.
Undeniable utility.
But on the other hand, you have this really risky token structure. Poor launch management, huge amounts of supply held back by insiders, guaranteed unlocks coming down the pipe.
Exactly. It's a classic crypto dilemma.
Yeah.
Amazing tech, questionable tokenomics.
So the bottom line, according to the sources, really seems to be about usage. Will people actually use Plasma enough?
That's the core question. So the thought to leave you with is this. Can truly groundbreaking utility, like sending stablecoins instantly for free, generate enough real-world demand to actually overcome the massive predictable price pressure that's built into the token's future supply schedule, especially with those huge unlocks looming in 2026.
It's a tough balance. Utility versus token supply, that's definitely something to keep an eye on.